Today, credit is booming. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, it's the end of the month yet again, and so we've had the data from both the RBA and APRA relating to credit aggregates. And today I just want to walk through that data. It shows some quite interesting trends, but also raises some rather worrying questions. Let's first start with the RBA financial aggregates, which showed that to the year end, to May 2021, overall credit grew by 1.9% compared with 3.2% in May 2020. Or in monthly terms, it rose 0.4% compared with 0.3% last month. Breaking it down, housing rose 4.8% over the last 12 months compared with 3.2% the previous year. But over the last month, it rose from 0.5% in April to 0.6% in May. Personal credit over the last 12 months fell 6.4%, and that is a smaller drop than the 10.3% a year earlier. And in the month of May, personal credit actually rose by 0.2%, whereas it was flat the previous month. And business credit, which was down 2% over the last year, compared with a rise of 5.7% a year earlier, rose just 0.2%, compared with a fall of 0.3% the prior month. And lastly, broad money was up 6.8%, compared with 9.3% a year ago, and was up 0.2%, which was the same as last month. So let's look firstly at the credit aggregates on a monthly basis. And housing rose 0.59% over the last month. Within that, owner-occupied lending rose 0.68%, and investment rose 0.35%, just slightly lower than last month. Personal credit was up 0.17%, and business credit was up 0.2%. We can also look at the credit aggregates all credit move, and that was 0.43%, which was slightly better than last month. And the broad money was up just 0.24%. And again, we are seeing the shakeout of the very significant liquidity that was provided post the COVID event last year. But really, the analysed numbers tell a better story because the monthly numbers are very noisy. And here, housing was up 4.78% for the 12 months to May 2021 and continues to rise, but is still significantly below where it was in 2016 and 2017. Owner-occupied credit growth is quite strong at 6.56%, but still not as strong as the 8% or thereabouts in 2016. Investment lending was up 1.63%, and that is an interesting acceleration now. We are definitely seeing a change of trajectory as more investors come into the market. Personal credit, which took a big dip, is still down 6.41% over the last year, but is beginning to climb back towards zero now. Whilst business credit, which was down more than 2% over the year, has turned up just slightly. And then looking at the overall credit growth at 1.91%, slight move up, but still, as you can see, very, very low relative to the averages over the last few years. Broad money was still at 6.77% higher than a year ago, But that, of course, is still relating to those big spikes that we saw earlier on last year. Now, if we turn to APRA, they also issued their monthly authorised deposit-taking institution statistics for May. This relates, of course, to the banks and reports the total loans outstanding, in other words, new loans on minus repaid loans off, as well as loans that were refinanced and otherwise continued in the bank. It is a bit confusing insofar that they may, for example, have sold off loans into securitization pools, and that would actually reduce the balances. So it's not a clean number, but it is quite interesting to get a rough sense of what's going on. So firstly, the total stock of credit for home lending rose again to $1.844 trillion. Within that, the investment proportion fell further. It's now sitting at 35% of all credit outstanding. And if you translate that into monthly moves, owner occupation loans rose 2.2% over the last month. Investment lending was up 0.72%. And so total credit was up 1.68% over the last month. And you can see the acceleration very clearly there from March onward. And that's a combination of significant demand from borrowers and also easier lending standards being applied by lenders. Now, we can also look at the selected portfolio movements between April and May. And the interesting thing here is that the usual suspects like Commonwealth and Macquarie are there, but also Westpac now is lending big, particularly for the owner-occupied sector of the market. NAB is also there quite strongly, but they're also continuing to reduce their exposure to investment lending. Westpac more than NAB. Beyond that, we have Bendigo, HSBC, Bank of Queensland, and Members Equity, and then the rats and mice in terms of movements. Although interestingly, Defence Bank, I noticed, dropped their owner-occupied portfolios but lifted their investment portfolios. Now, whether that's a reclassification event, there's no way of knowing. But what we can say from this is that there are clearly still some different strategies being executed by individual lenders with regard to what they're prepared to lend, how much they're prepared to lend, and to whom they're lending. And this, I think, will continue ahead because the competition for new loans is actually bubbling up. And I've seen a number of advertisements on the television recently from the banks trying to persuade people to refinance existing loans and pull out equity thanks to the rising house prices and low interest rates. So it's interesting to see whether that plays out into the future. But there's something else to bear in mind, and this came in today from CanStar, highlighting the fact that NAB has increased fixed home loan rates, and they suggest it's time to start planning for higher repayments. NAB has today announced an increase in its rates on its 2-, 3-, and 4-year fixed rates by up to 0.1% for owner-occupied loans with principal and interest repayments. That's the second time in 2 months that the bank has hiked its 4-year fixed rate, having increased this rate back in May by 0.21%. All of the big four banks still offer 2-year fixed rates below 2%, while Westpac is the only big four bank to offer a 1- and 3-year fixed rate below 2%. Commenting on the fixed rate loans, CanStar's Steve Mickenbecker said NAB's increase to its 2-, 3-, and 4-year fixed rates is a further confirmation that markets are expecting rates to move inside the Reserve Bank's 3-year timeframe. 4-year fixed rates have been hardest hit with increases, and today's seemingly trivial increase is on top of the bigger increase in May. The rates on longer fixed home loans have now opened up a wider gap above the shorter-term 2 and 3 fixed deals, when only 6 months ago they were the lead rates for some banks. The Reserve Bank's 3-year term funding facility, providing cheap funding at 0.1%, is now history, marginally lifting funding costs for the banks. Borrowers should be planning now for the day when rates start to rise, And whether it's 18 months or 3 years away, they will be up for high repayments. These fixed interest rate increases from lenders don't impact existing borrowers, but it does put them on notice that they'll be up for high repayments in the future. So now is the time to get ahead through extra repayments and cutting the loan back while they can. Well, I think that's very good advice, because it is clear to me that we are going to see upward pressure on interest rates. I also make the point that we are seeing quite a lot of changes under the hood to lending underwriting standards. And essentially the banks are getting a bit more picky and asking a few more hard questions again, having recently, frankly, dropped the ball. Now that may well be in reaction to recent pressure from the Reserve Bank and indeed from APRA, highlighting the need for banks to maintain caution when it comes to lending standards. So the key takeaway from this conversation is that if you are thinking of committing yourself to a mortgage, you should do some modelling, not based on the currently available interest rate, but on the rate that may go higher over the next year or 2 or 3. And generally my thought is that you should include a buffer of 2 or better 3%. Now of course the banks include some buffering when they make their assessments, but their assessments are not necessarily accurate when it comes to real cash flows of real households. Ensure that they have enough wriggle room if indeed interest rates do rise. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.